There are many factors affecting a firm's accounting choices. Contracting incentives predicted by positive accounting theory is only one of the many. Positive accounting theory focuses on dynamic relationships among stakeholders within the firm. However, business organisations do not operate as a silo. Their actions influence many others in the operating environment. They are also influenced by others. But positive accounting theory is unable to offer insights in relation to factors of influence beyond the firm level. These influential factors include pressures and criticism from the media, lobby groups, the labour market, and the local culture. These forces are different from those covered in the political cost hypothesis in positive accounting theory. The political cost hypothesis explains why firms choose accounting policies that have direct economic consequences to avoid political costs. But firms often report information and adopt practices that do not seem to make economic sense. Such a perspective is addressed by systems-oriented theories. Systems-oriented theories help us to make sense of the business and social dynamics among competitors, with the institutional environment in which the government is the representative, with individuals and groups that do not have a direct financial interest in the firm, and with the social environment which is represented by the local culture, norms, customs, ethics, religion, and beliefs, etc. These theories focus on the role of information and disclosure in the relationships between firms, relationships with the government, and relationships with individuals and groups. Such a focus is premised on the idea that the firm is influenced by the society in which it operates. In turn, it influences society. The strand of theory includes stakeholder theory, legitimacy theory, and institutional theory. Stakeholder theory and legitimacy theory have been applied extensively to explain why firms might make certain social responsibility disclosures within their annual reports or in sustainability reports, rather than why they might elect to adopt particular financial accounting methods. Institutional theory underlines why firms adopt certain accounting methods to represent financial wealth in order to satisfy the institutional requirement. The stakeholder theory consists of two branches: the ethical normative branch and the managerial positive branch. Under the ethical branch, the firm is viewed as a part of a wider social system. Stakeholders are any group or individual who can affect or be affected by the achievement of the firm's objective. They include shareholders, employees, customers, lenders, suppliers, local charities, interest groups, and government. All stakeholders have a right to be provided with information. This branch prescribes how stakeholders should be treated. It is a normative approach based on various ethical perspectives. The managerial branch seeks to explain and predict how a firm will react to demands from various stakeholders. This process considers the relative power or importance of stakeholders. The power relativity or importance relativity can change across time, depending on the control of resources critical to the firm. Financial and social information is used to manage conflicting demands from various stakeholder groups. Management will respond to information demands from stakeholders perceived as powerful. From this perspective, if a stakeholder group does not have power, their information demands might not be met.
Grace, to calm the union down, we'd better give them a breakdown of employee benefits we spent this year and the information on employee turnovers, as well as the reasons for the employee departures. It'll cost us extra money to prepare and report the information, but I think it's worthwhile, especially considering the cost to us if the union and our employees were to go on a strike.
Okay, I approve. But what about the local Greens community? They're making noises too, demanding more information from us.
The Greens don't have much economic influence though, so they can't do much damage, and they're demanding information that is not required by law. I wouldn't bother entertaining their information needs at all.
However, neither branch prescribes what information should be disclosed, other than indicating that the provision of information can be useful for the continued operations of the firm. By applying the stakeholder theory, regulators can understand why some disclosures are being voluntarily made by firms, while other important disclosures are not being provided. This has implications for the need to potentially legislate particular disclosures. Firms are seen to continually seek to ensure that they operate within the bounds and norms of society, which again can change across time. So, firms must appear to consider the rights of the public at large, not just investors. Legitimacy theory is based on the concept of social contract, wherein the firm is considered to have a contract with society. Under the social contract, the firm must ensure that its activities are legitimate from the society's perspective. When firm behaviours do not conform with the acceptable bounds and norms, this social contract is perceived as being breached. The firm will need to take corrective action, which might include disclosure. Research using this theory shows that when the legitimacy of a firm is being threatened, perhaps as a result of an incident like an oil spill, the firm will use information disclosure to try to maintain or regain legitimacy. Stakeholder theory and legitimacy theory have some overlaps. Both theories explicitly consider the firm in its broader social context. These theories do not rely on the assumption of self-interest. Institutional theory explains why firms within particular fields tend to take on similar characteristics and form. It has some overlap with stakeholder theory and legitimacy theory. There are two main dimensions to institutional theory: isomorphism and decoupling. Isomorphism is defined as a constraining process that forces one unit in a population to resemble other units that face the same set of environmental conditions. That is, if firms adopt structures or processes, such as reporting processes, that are different to other firms, they might find that such differences will attract criticism. This can result in investors withdrawing their capital. Decoupling refers to the situation in which the formal firm's structure or behaviour is separate and distinct from the actual firm practices. In other words, the practice is not integrated into the firm's managerial and operational processes. Thus, the actual practices can be decoupled from the apparent institutionalized practices. Isomorphism is further divided into three different processes: Coercive isomorphism arises when firms change their institutional practices or provide particular disclosures in response to pressure from powerful stakeholders. The firm is therefore coerced by its influential stakeholders into adopting particular reporting practices to bring them in line with the expectations and demands of its powerful stakeholders. This is similar to the managerial branch of the stakeholder theory. Mimetic isomorphism involves firms seeking to mimic or copy or improve upon the institutional practices of other firms, often for reasons of competitive advantage. Normative isomorphism relates to the pressures arising from group norms to adopt particular institutional practices. In the case of corporate reporting, the professional expectation that accountants will comply with accounting standards acts as a form of normative isomorphism for the firms to produce accounting reports that are shaped by accounting standards. In terms of voluntary reporting practices, normative isomorphic pressures could arise from less formal group influences, or from a range of both formal and informal groups to which managers belong. For example, the culture and working practices developed within their workplace. In conclusion, the positive accounting theory and the systems-oriented theories provide insightful theoretical rationale and predictions to help us understand firms' reporting behaviour and their choice of accounting and non-accounting methods.